Investing in the stock market can seem daunting for beginners. It's like a big puzzle, but don't worry, we'll break it down. When you buy a stock, you're buying a tiny piece of a company. It's like owning a small slice of your favorite pizza place. As the company grows and makes more money, your piece becomes more valuable. That's how you make money in the stock market. You're sharing in the company's success. Of course, there are risks too. Just like any business, a company's value can go down. That's why it's important to do your research and invest wisely. Remember, investing in the stock market is a marathon, not a sprint. It's about long-term growth, not getting rich quick. The stock market has a long history of going up over time. This trend has been observed for over a century with various periods of growth and decline. Despite the ups and downs, the overall trajectory has been upward, reflecting the growth of economies and businesses. Think of it like a roller coaster that generally goes uphill. There are thrilling highs and stomach-churning lows, but the general direction is upward. This analogy helps to understand the inherent volatility and the long-term growth potential of the stock market. Over the past 30 years, the stock market has returned an average of almost 10% per year. This impressive average return is a testament to the power of investing in a diversified portfolio of stocks over the long term. That means if you invested $1,000 30 years ago, it would be worth over $17,000 today. This example illustrates the magic of compound interest, where your investment grows exponentially over time. But remember, the past doesn't guarantee the future. While historical returns provide a useful benchmark, they are not a promise of future performance. Market conditions can change, and various factors can influence future returns. Just because the market has done well historically doesn't mean it always will. Economic cycles, geopolitical events, and changes in market sentiment can all impact stock prices. It's important to stay informed and be prepared for different market scenarios. The market can be volatile, meaning it can go up and down a lot in the short term. This volatility can be unsettling, but it's a normal part of investing. Understanding this can help investors stay calm during market fluctuations. There will be times when the market goes down, even sharply. These declines can be triggered by various factors, such as economic recessions, financial crises, or unexpected global events. It's crucial to have a long-term perspective during these periods. These are called market crashes. They are severe and sudden drops in stock prices that can lead to significant losses. However, history shows that these crashes, while painful, are often followed by periods of recovery and growth. But the good news is that the market has always recovered from crashes in the past. This resilience is a key reason why many investors choose to stay invested through thick and thin, trusting that the market will eventually bounce back and continue its upward trajectory. There are a few different ways to approach the stock market. Each method has its own set of strategies, risks, and potential rewards. Let's talk about investing first. Investing is often seen as a more stable and long-term approach. Investing means buying stocks for the long term, like holding onto them for years or even decades. The goal is to benefit from the company's growth and earn dividends over time. It's like planting a tree and letting it grow. You nurture it, give it time, and eventually it bears fruit. You don't dig it up every day to see if it's grown taller. Instead, you trust the process and have patience. Trading, on the other hand, is a different ballgame. Trading is about buying and selling stocks more frequently, trying to make quick profits from short-term price movements. Traders often rely on technical analysis and market trends. Think of it like flipping a house. You buy it, fix it up a bit, and then try to sell it quickly for a profit. The key is to capitalize on market fluctuations. You buy it, make some improvements, and then sell it as soon as the market conditions are favorable. Speculating, however, takes on even more risk. It's like gambling on which way the market will go in the very short term. Speculators often make high-risk bets, hoping for significant returns. It's not for beginners and can lead to substantial losses. Whether you choose to invest, trade, or speculate, it's crucial to understand the risks involved and to educate yourself thoroughly. Each approach requires a different mindset and strategy. To buy and sell stocks, you need a brokerage account. Think of it like a bank account for your stocks. These days, online brokerage accounts are the easiest way to get started. Many offer zero commission fees, which means you don't have to pay anything to buy or sell stocks. Now let's talk about dividends. Some companies share their profits with their stockholders by paying dividends. It's like getting a small bonus just for owning the stock. You can even choose to reinvest those dividends automatically, which means you'll buy more shares of the stock with the dividend payments. This is a great way to grow your investments even faster. Section 5. Index funds and ETFs for beginners. Index funds and ETFs are like baskets of stocks that track a specific market index, like the S&P 500. The S&P 500 is like a VIP club of the 500 biggest companies in the US stock market. When you invest in an S&P 500 index fund, you're basically buying a tiny piece of all 500 companies at once. This is a great way to diversify your investments, which means spreading your money across many different stocks. Diversification is important because it reduces your risk. If one stock in the basket doesn't do well, it won't hurt your overall portfolio too much. Section 6. Active versus passive management. There are two main ways that investment funds are managed, actively and passively. Active management is like having a personal chef for your investments. These fund managers try to pick the best stocks and time the market perfectly, but just like finding a great chef, it can be expensive. Passive management, on the other hand, is like using a meal kit service. It's simpler and cheaper. Passive funds simply track a specific market index like the S&P 500. They don't try to beat the market, they just try to match it. For most beginners, passive investing is the way to go. It's low cost and effective. Section 7. Diversification and dollar cost averaging. We've already talked about diversification, which is like not putting all your eggs in one basket. But how do you actually do it? One way is to invest in a variety of different stocks and sectors. Don't just invest in tech companies, for example. Spread your money across different industries like healthcare, energy, and consumer goods. Another way to diversify is through dollar cost averaging. This means investing a fixed amount of money at regular intervals, like every month or every paycheck. This way, you'll buy more shares when the price is low and fewer shares when the price is high, averaging out your cost over time. Section 8. Key stock metrics and market terminology. Now let's decode some stock market jargon. Understanding these terms can help you make more informed investment decisions and navigate the financial markets with greater confidence. The PE ratio, or price-to-earnings ratio, tells you how much investors are willing to pay for every dollar of a company's earnings. It's a crucial metric for evaluating whether a stock is overvalued or undervalued compared to its earnings. Think of it like the price tag on a stock. Just as you wouldn't want to overpay for a product in a store, you don't want to overpay for a stock. A high PE ratio might mean investors are very optimistic about the company's future growth. However, it could also indicate that the stock is overpriced. Conversely, a low PE ratio might suggest that the stock is undervalued or that the company is facing challenges. Dividend yield is the percentage of a company's share price that it pays out in dividends each year. This metric is particularly important for income-focused investors who rely on dividends for a steady income stream. It's like the interest rate you get on a savings account. A higher dividend yield can be attractive, but it's also essential to consider the company's ability to sustain those dividends. A bull market is when the stock market is going up, characterized by rising stock prices and investor optimism. Bull markets can last for months or even years and are often driven by strong economic indicators and corporate earnings. While a bear market is when it's going down. Bear markets are marked by falling stock prices and widespread pessimism. They can be triggered by economic downturns, geopolitical events, or other factors that negatively impact investor sentiment. Quantitative easing is when the Federal Reserve, the US central bank, pumps more money into the economy by purchasing government securities. This increases the money supply and lowers interest rates, which can stimulate economic activity and boost stock prices, Investors often view quantitative easing as a positive signal, as it can lead to increased liquidity and higher asset prices. Quantitative tightening is the opposite, where the Federal Reserve reduces the money supply by selling government securities or letting them mature without reinvestment. This can lead to higher interest rates and reduced liquidity in the financial system, and it can sometimes lead to a market downturn. Investors may react negatively to quantitative tightening as it can signal a tightening of financial conditions and potential challenges for economic growth. Section 9. Conclusion, seeking professional financial advice. Congratulations, you've just completed Stock Market 101. You now know more about investing than most people, but remember, this is just the beginning. There's always more to learn about the stock market. Before you invest any money, it's crucial to do your own research and consult with a qualified financial advisor. They can help you create a personalized investment plan that aligns with your financial goals, risk tolerance, and time horizon. Investing can be a rewarding way to grow your wealth over the long term. Just remember to start small, stay informed, and seek professional guidance when needed.